When Robert Bass, the American businessman and philanthropist, decided to open a new family office to manage his considerable net worth, he turned to Mark Anson. Anson is CIO and co-founder of Acadia Investment Management, Robert Bass's family office. He is among a handful of pioneers advancing private wealth management, setting new standards for hedge fund investment and portfolio construction today.
What's really important for investors when they look at their hedge fund returns is to beta adjust those hedge fund returns. You can't compare hedge funds to the equity stock market. It's not a pure apples to apples comparison. You really have to take into account what's the level of systematic risk those hedge fund managers are taking in their portfolio, because many of them are going both long and short the market. So they don't have the same level of exposure to the market that just being in a traditional long-only equity product would. So as we move forward, I see more and more of these smart betas, quote, smart betas. Sometimes I think they're actually dumb betas, but they get the title smart betas, trying to capture some of the skill or the essence of what made hedge fund managers special. And that's going to lead to a couple consequences. First, investors are going to demand more from their hedge fund managers in terms of creative alpha. And second, they're going to ask, my gosh, should I pay 2 and 20 if there's now some ETF out there that captures the carry trade? Or there's even an ETF that captures the momentum trade now. And then from the investor side of the table, they're going to be all the more critical of hedge fund returns and start asking those always difficult questions. What am I paying the 2 and 20 for? The discussion on fees is much more open. Now, that's had very little impact on the 2 and 20 business model, but there has been some movement there. So for instance, many hedge fund managers now offer a fee break if you're willing to lock up your capital for a longer period of time, let's say 1 or 2 or 3 years. You never got that 10 years ago. You do get that today. As the hedge fund industry has matured, it has become more institutionalized. That transparency has led to better dialogue between investors and hedge fund managers, and as a result, the pendulum is getting closer to the middle. Maybe it's not there yet, but it's certainly closer than where it was 5 to 10 years ago. When we look at our hedge fund portfolio, we really want to see more alpha than beta. Who doesn't? But at the same time, we're also making certain that we're not getting as much market exposure in our hedge fund portfolio that we get in other parts of our portfolio. In fact, the way we look at our hedge fund portfolio, because it has lower volatility and lower exposure to the broad markets, is we consider it as a way of buying risk units that we can then spend on the riskier parts of our portfolio. So we want to ensure that, one, our hedge fund managers are really bringing alpha into the portfolio, and two, that they're sticking to their knitting and actually providing lower exposure to the markets and lower volatility, such that they're allowing us to buy those risk units that we can then spend on other parts of our portfolio that are more risky.